Glenn, virtual investor here, and in today's update, I want to go over the markets. I haven't done market update here in a little while, and just want to talk about what's going on, what we're seeing from an investor standpoint, not from a traditional buyer standpoint, but also tell you what traditional buyers are doing right now based off our fix and flips. So because the rates have shot up, and today's rates are around 6.97 for a 30-year mortgage, on average. Some are a little bit lower. I think Freddie Mac has it around 6.66, but it's changing the market, right? The market is changing before our eyes. And what we're seeing happen now is a good thing if you're an investor or you're looking to become an investor. You're losing a lot of competition. A lot of investors are turtling up and they're going into hiding and they're waiting to see what goes on. I don't think it's time for people to do that. I think now's the time to be looking for deals and finding them and buying them, right? And you want to just be a little bit more careful with what you're doing. So let's say on average, you're a new investor and you're looking to buy a property. You want to pick something up at, say, 75% of after repair value minus repairs or minus what your wholesale fee is. Change your numbers. I'm actually going super conservative. A lot of people are going 72, 73%, or a lot 70. We were teaching our students 70. I'm going to pull back even more now to 65% of that. The reason being is just too much uncertainty, too high. The mortgage rates are going up too quickly because what the Federal Reserve is doing here with quantitative easing and with increasing the short-term rates, which is in effect also increasing the long-term rates because it's created so much uncertainty in the market. You see the stock market getting hit. Cryptos, all the precious metals, every market is getting hit, partly too because of the strong dollar. The dollar has been going up, and that's been hurting other asset classes because people around the world are now putting money into dollar-based assets. So what's going to happen from here? I think it was the United Nations, UN, just said they want all the central banks to stop increasing the rates because it's killing other countries around the world. If they do that, where this may lead us to is ultimately lower rates, interest rates, short-term and long-term. They stop right now. If they literally stop and don't increase the rates, forget about decreasing the short-term rate. If they don't increase the rate, people and investors will feel a little bit more secure. They'll breathe a little bit easier, and they'll put more money in the stock market. They'll put more money in the crypto market. They'll put more money into real estate again. And the secondary market, which is mortgage buyers that buy mortgages. So let's say you're working with one of the big lenders out there, whether it's RCN Capital, Kiavi, Lending, One, whichever, Line One Capital. Those guys create these mortgages and turn around, most of them turn around, sell them to the secondary market. There are some that keep theirs, but most of them turn around, sell them to the secondary market. When the secondary market doesn't have an appetite for these mortgages, then the result is all these lenders turtle up and offer you lesser LTV. They start pulling money. They're out of certain markets. They don't want to hit certain price points. There's just so much uncertainty that they don't want to lend. And it just creates a tighter lending environment. With a tighter lending environment, you have less buyers out there, right? So ultimately that pushes prices down. It's a pretty basic macroeconomic factor here. So where are we headed? I feel we're headed where they're going to stop raising the rates. Eventually, they may even pull back the short-term rates. But if they stop raising the rates here because the UN, everybody's throwing a fit, then what you'll see is liquidity come back into the market, things stabilize, more investors going out there and buying, whether it's stock market, crypto, or real estate. So if you're an investor, now may be a great opportunity because there's less buyers out there. So maybe you jump in, buy something now, get a nice discount. And then when the market softens a little bit, gets a little bit better, meaning, right, there's more opportunity out there. Then there's more buyers out there because maybe mortgage rates drop a little bit. Maybe they go from 6.9 to 5 again. A lot of people just want that 5.5 and below interest rate. So I think when you do that, then you create greater demand in the real estate markets. That's kind of where I think we are. I want to do a quick little screen share here with what I'm seeing. I'll go over some of the Redfin data. The median home sale price is 406,000, which is up 6.7% from last year, which is kind of amazing considering interest rates, right? Which shows there's still demand for real estate. But there's not enough inventory, which is keeping prices higher, even though they are in decline. And this time of year in the fall, they typically do decline. We're in October 2022, so they are typically going to be declining this time of year, getting into the holidays. It'll ramp up again in really February, more March, April, May, and June of next year. So the number of homes sold is down 17.5% from last year. Part of that's because of lower inventory, but a bigger part of that is because of higher interest rates. Just flushed a lot of buyers out of the market. And the national average interest rate they're calling it 5.2, but it's much higher than that now. This was a little while ago, a month ago. It's closer to 7 now, which was 2.4% at 5.2. So now you're over 3%, probably about 3.8%, somewhere in that range above last year. So the interest rate's a big factor. It's an important one to take into consideration. Now let's go into the top 10 metros in the United States with the fastest growth right now. Again, this is month ago data. My market, Naples, Florida, is now the #1 market in the US, up about 28% year over year. Boca Raton, 26. Look, you see mostly Florida in here. You got Palm Bay, Florida, Miami, Florida, West Palm Beach, Florida, Boynton Beach, Riverview, Florida, and Port St. Lucie, Florida. The only other markets you have out there are Myrtle Beach and El Paso, Texas. Very interesting. El Paso's gotten there because I think it's a pretty affordable place to live. And I think that's why it's cracked this list here. So it could be a good one for investors for the long term. Once these prices settle down a little bit here. Could be a cash flow rental area. It's something I'm going to have to look into here. But anyway, these markets are still your hot markets, which is showing the Sun Belt is still where people want to be. Arizona has a lot of inventory right now, so that's hurt their markets, pushed things down a little bit. People still want to go and retire and move there, though. Texas, people are still going to move there, not necessarily retire there, but there's a lot of jobs there. Tennessee, another great market to move to. And Florida, all these are zero income tax states, and they have that in common, and are also more desirable place to live, better weather than you have in the Northeast or up in the northern parts of the country here. So desirable place for people to go. It's going to continue that way. Rates will affect every market, no matter where you are. Rates will affect it. If you have greater inventory in your market, it's going to affect it even more. If you have less inventory on your market, it's going to affect it much less. That's basic supply and demand. If there's not a whole lot out there to buy, there will still be bidding wars. So keep that in mind. But if you're a first-time investor out there looking to get in, now would be a phenomenal time. This is when we get most of our deals this time of year, October, November, December, and January from the banks. This is when we acquire a lot of inventory, and we are doing that again this year. We got 3 more under contract last week. I believe it's 2 in Texas and 1 in Tennessee. So we're doing, or 1 in Michigan, sorry. So we're doing pretty well with that. And that's only with one of our acquisition guys, right? I'm not even ramping it up with other 2 yet. We're just kind of taking and seeing what we got here in this market. And this is the time of year to pick up a lot of good inventory. So if you're looking to jump into and get into real estate, now would be the time. We have a couple specials going on. We have a do-it-yourself program, which instead of $997 is down to $497. We'll probably have that good through the end of the year. The total deal is if you want to do a package here where you want the do-it-yourself purchase and how to sell these properties yourself, it's $997 for a package. So you're getting 2 for 1 right now, special here through the end of the year. If you guys are looking at doing that, I'm going to put the link in the description down below here. Feel free to reach out to us and we can help you with that. If you're looking for a full-fledged coaching, hand-holding, doing joint venture deals, that is $5,500 right now on that program. If you're just somebody who is already investing in real estate, but you want to dabble into the bank-owned stuff and want to see how it goes, you can actually join up for $97 per month. You do it on a month-by-month basis and unsubscribe whenever you want. But you'll have access to our coaching calls, access to our lenders, access to all kinds of information you're not going to get otherwise. All right, guys, I hope you got a lot out of this video. If you did, make sure you click like on here and subscribe to our channel, and we will catch you on the next video.